Hello, accounting kids. This is Mrs. Martin. We need to get going. I have tried to contact Cengage with no luck, so we're just going to keep going and use our workbook, and we'll figure out a way to make it work. So I want to continue on with lesson 11, or chapter 11, excuse me. What this chapter is going to be about is accounting for transactions using a general journal. So we have already talked about a general journal. We just finished up talking about special journals. And I think one thing that's important to know is that there are transactions that cannot be recorded in special journals. For an example, if it's not a cash payment, it cannot be recorded in a cash payments journal. If it's not a transaction with a purchase of merchandise on account, it cannot be recorded in the purchases journal. So any transaction that cannot be recorded in a special journal are recorded in a general journal. So with lesson 11.1 here, we're going to explain the purpose of a general journal, account for purchases, returns, and allowances, host a general journal to the accounts payable ledger, and general ledger. So I'm just going to make this slideshow bigger here. So let's talk about a general journal. So a general journal is a journal with two amount columns in which all kinds of entries can be recorded. So like I mentioned before, we just finished going over special journals. So there are some transactions that can't be recorded in special journals. So the book had an example about when a company buys supplies on account, so what would we debit and credit? So if they're buying store supplies on account, we would debit store supplies and credit accounts payable, right? So could that go in the cash payments journal? No, it could not, because it was not a cash payment. Did we make a transaction purchase of merchandise on account? We did not, so it cannot be recorded in the purchases journals. Therefore, it has to be recorded in the general journal. So let's talk about a memorandum for buying supplies on an account. So when we get an invoice from a vendor saying attached here is an invoice for supplies bought on account. So this is a pre-numbered memorandum that's going to be attached to the invoice noting what it's for. Okay, so this is saying it was for store supplies. It's not for purchases. So we know that the invoice gets paid and recorded correctly, because if we thought it was for purchases, it would go in the purchases journal. So we need to make sure we're looking at the memorandum and what it says. So attached invoice is for supplies bought on account. So when we buy supplies on account, let's talk about how we journalize this. So again, we cannot put it in a special journal, so we're talking about putting it in a general journal. So, December 2nd, we bought store supplies on account from Estes Supply for $165. Memorandum number 42. That's this memorandum that we just saw, okay? So, it was $165.25. So what do we know? We bought store supplies. So we know what? What is our debit? Our debit would be our supplies, and we would want to do the supplies-store. And then we bought supplies on account. So that means that what would our credit be? And I know you're all answering out loud right now, accounts payable, and you are correct. So our transaction would be, we're going to debit supplies for the store. And why do I have a dash after store? Well, there could be multiple supplies accounts, and we know that this is for store supplies. So we want supplies store. We're going to debit because it's net. Its normal balance is a debit. So under increasing it, we would debit it. And then accounts payable, the normal balance is credit. So if we're increasing our accounts payable, that means that is increasing the amount that we owe this company. So we're going to credit accounts payable for $165.25. And so I just showed you here down that this is what the transaction would look like in the general journal. So you would supply store debit, accounts payable, Estes Supply, and remember, we have our main account for accounts payable, and then we have all those subsidiary accounts. We want to make sure that we're charging it to the right account, Estes Supply, that way it only goes to that balance. so we know who we owe. So we have our date, our account title, memorandum number, our debit amount, account title and vendor name, diagonal line, and the credit amount. So we're placing a diagonal line in the post reference column on the same line to show that the single credit amount is posted to the general ledger account. So because we're just posting it to accounts payable, because we're going to post it to two, we're going to post it to accounts payable, and we're going to post it to the accounts payable ledger account. So we need to make sure that it's hitting the general ledger accounts payable, and then also Estes Supply. I hope you understand that. Because it's going to hit two account titles. So again, I think I'm explaining it correctly, but we have our controlling account, which is accounts payable, and then we have our subsidiary ledger accounts, which are all of the companies that we owe money to. So we need to make sure that we're posting it to both. So the controlling account balance is affected, as well as the subsidiary ledger account balance, because if we only do one and not the other, they won't match. So debit memorandum for purchases, returns, and allowances. So I want to talk to you, have we ever bought something that we want to return, right? Or if we ever got something that we weren't satisfied with, we want to retain, right? We don't, as customers, we generally do not want to keep merchandise that is inferior in quality, or if we ordered something and we get something different, right? We don't want to keep it. So if that happens, as a business, we have to allow our customers to return either part or all of that merchandise. So purchases returned, credit allowed for the purchase price of returned merchandise, resulting in a decrease in the customer's accounts payable to the vendor, is called a purchases return. Okay, so credit for the purchase price of the returned merchandise, resulting in a decrease in the customer's account payable. So now let's talk about purchases allowances. So when merchandise is damaged but still usable, or if it's of a different quality than ordered, the vendor may let the customer keep the merchandise at a reduced price. So credit allowed for part of the purchase price of merchandise that is not returned, resulting in a decrease in the customer's account payable vendor, is called a purchases allowance. So in the first one, they're returning the whole item. In the second one, we're letting them keep the item maybe at a reduced cost. So a purchases return or allowance should be confirmed in writing, and a form prepared by the customer showing the price deduction taken by the customer for a return and allowance is called a debit memorandum. So it's called this because the customer records the amount as a debit to the vendor's account. So you're thinking, why would we do a debit to the vendor's account? Because we are actually decreasing the amount owed, right? Customer may use a debit memorandum as a source document for journalizing a purchase's return or allowance, or the customer may write for a written confirmation from the vendor and use confirmation as a source document. So I know it's a lot of terms here, but I want you to understand the first one is returning the whole thing. The second one's keeping the customer keeping the merchandise for a reduced price, and the debit memorandum is the form showing the price reduction for a return or allowance. So here showing is a debit memorandum. So it shows number 38 here to Mobley Tools. So 2 of the 8-watt power tool batteries. The price $21.95 total is $43.90. So let's talk about this. So we return merchandise to Mobley Tools for $43.90, covering purchase invoice $528, debit memorandum $38. So what will we do in this situation? we know it's going to affect our accounts payable, right? Typically when we're setting up an accounts payable, it's a credit. So if we need to reduce that accounts payable, it would be a debit. So we know that our debit would hit two accounts, right? What are the two accounts? Accounts payable as our controlling account, and then Mobley Tools as our subsidiary account. Okay? Then we have to use a new account titled Purchases, Returns, and Allowances. So this allows businesses to track the amount of purchase returns and allowances that they give in a fiscal period. And I guess it also helps them evaluate how efficient its purchasing activities. So maybe if they're having the same item returned all the time or the same item's breaking, maybe they can look at that and do an analysis to see if, oh, maybe we shouldn't have this in our store. So let's look at the transaction. So like I said, we're going to debit accounts payable because we're going to reduce the amount that is owed. Then we are going to credit purchase returns and allowances. So purchase returns and allowances is a contra account to purchases. So the normal balance of purchases, returns, and allowances is credit, the opposite of the normal balance debit of purchases. So think of it as when you have purchases, that's going to have a normal balance of debit. And think of returns and allowances. So you made your purchase, but you don't want you returning it, so that's going to have the opposite balance, and that's going to have a credit normal balance. So both purchases and purchases, return, and allowances are listed in the cost of goods sold chart of accounts usually. So let's now go and show the general journal transaction. So again, we're just journalizing what we did in our T account above. So our date is the 8th. Why did we not put December? Because we already had it one time. So above in our other transactions. So again, our accounts payable, Mobley Tools, we have our document number, which is our debit memorandum, 38. And we need to put the diagonal line again to show that that amount is posted to two accounts. So it's posted to accounts payable controlling account, and then it's posted to the accounts payable ledger account or the subsidiary account Mobley Tools. So we're going to debit. So when we post those to the ledger, we will post it twice. But so the debit will be $43.90 and the credit will be $43.90. So again, those balance. And we'll just go through and show all these things. All right. So now, posting from a general journal to accounts payable ledger. So we have here the general journal up at the top. You can see those are the two transactions that we just went over. So now we need to post to the accounts payable ledger. Remember, those at what you see below are those subsidiary accounts. You see those vendor accounts that show this is where the accounts payable ledger is where we hit those subsidiary accounts. The general ledger would be where we hit the accounts payable account. So since we had that diagonal account up there, we need to post those. So as you can see, we posted the accounts payable for the December 2nd transaction, the accounts payable Estes Supply. So you see on the bottom half of that diagonal in the box, we put a 220 there. That is because we posted it to the accounts payable ledger below. So you see where it says vendor Estes Supply. We posted December 2nd, General Journal 12, page 12 of the General Journal, and we put that credit amount of $165.25. So since we have a normal balance in our accounts payable ledger of credit, we're adding to that balance, so our new balance is $985.25. So for Mobley Tools, we are going to up here debit, because this is for our returns and allowances. So we're going to debit $43.90. So down here you can see debit. So now that's going to reduce the balance in which we owe Mobley Tools. Okay, so you see up here I put $240 then, and